So today I thought we'd go over the first lien HELOC. This is one of the things I typically go through as part of our cash flow optimization. This is a way that you can essentially eliminate what is for many people their biggest monthly expense, namely your mortgage payment. This is a much more efficient way to pay off your debt, to buy a house, or to pay off your house. And it can free up a dramatic amount of cash flow. Because again, it's all about cash flow. Okay, so again, you can pay off your house in as little as 5 to 7 years with no additional out of pocket just by making more efficient payments. Okay, obviously you're going to save in costs. You can use your home equity the home equity of your primary residence to make investments. And of course, you'll have access to the equity in your house should you have some form of emergency. And again, this maximizes your cash flow by practicing what is known as velocity banking, which is pretty much running your cash flow through your home equity rather than through a standard checking account. So again, we're leveraging all of our cash flow now by running it through a much more efficient cash flow management tool, a first lien HELOC, rather than a checking account. Okay, so again, some people hear HELOC. Well, this is not your standard HELOC, okay? Your standard HELOC is in second position, typically, meaning you have a mortgage, and then the HELOC is on top of that, okay? This actually replaces your mortgage, okay? So the first lien HELOC replaces your current mortgage, and your mortgage goes away. The total line of credit will be typically up to 90% of your home's value, okay? And then the amount you'll owe on that first lien HELOC will be equal to what your mortgage was. So you're replacing your mortgage and any outstanding home equity debt with first lien HELOC, and then you're running your cash flow through that first lien HELOC. So what are some of the differences here, right? So a mortgage is a closed-ended loan, right? Once you put money in, you can't pull it back out. Whereas with a HELOC, obviously, it's revolving. Money can go in and out freely. So as you pay down that HELOC, you could also pull that money back out if you needed it. The interest calculation, okay, so a mortgage uses the end balance from the previous month to determine the next month's interest payment. You are paying amortized interest with a mortgage, okay? On the HELOC, you are paying simple interest. So even though the interest rate may be higher on the HELOC, even substantially higher, you're going to end up effectively paying a lot less in interest. So this is using the average daily balance, okay, to calculate interest. And so if you're running your cash flow through this HELOC, you can see how that could dramatically reduce the amount of interest you're paying out of pocket. So the interest rate is not as important as you think. Okay, so how does it work? So you're going to be given a checking account that is linked to your first lien HELOC with an automated bidirectional sweep. So you deposit money into your checking account just like normal, and it all gets applied to your HELOC balance. You withdraw money from your checking account to make payments just like normal, and it all gets pulled out of your HELOC balance, okay? So it automates the process of velocity banking, okay? So money comes in, and then money goes out, just like a checking account today. So you're not doing anything differently. All you're doing is replacing checking account A that you're using today with checking account B that you'll be using tomorrow that will be attached to your first lien HELOC. So you won't be consciously making any payments. You're just running your cash flow through a different checking account such that all of your money is now working for you. All of that money that was potentially sitting idle in your checking account is now working for you inside your home equity. And it's working for you in two ways: by reducing your outstanding principal balance, which reduces the interest cost, and by participating in your home's appreciation in terms of the equity, right? So, and then whatever income you don't spend obviously reduces the principal, okay? And now we'll go into some examples. I won't go into too many details in this presentation, but there are others you can find, and I've done one with DeAndre Clayton where we went into some numbers, and I'll probably go into some examples of this with numbers. You can use their website too to see what it might look like for you. So we use an example. Let's assume you owe $300,000 on your mortgage. You have an income of $10,000 a month and expenses of $7,000 a month. Okay. Now, when we say expenses, we mean expenses minus your current mortgage, right? Because your mortgage payment is going to go away. So again, think about what your expenses would look like if you removed your mortgage payment, right? Pretty powerful. Okay, so you drop in your $10,000 of income into your checking account, which gets applied to your HELOC. So your $300,000 balance goes down to $290,000 at the beginning of the month. And then you pay your expenses of $7,000. Okay, so your principal was reduced by $3,000. Next month, you do the same thing. $10,000 of income comes in, $7,000 of expenses goes out at the end of the month. So now a $6,000 reduction in the principal over just 2 months. Okay. How would a mortgage work? Okay, let's say the mortgage, these rates are out of date, but they would kind of correlate the same way today. They'd probably both be higher, but here you can see a 3% mortgage and a 4.75% HELOC, right? So most people will look at that and say, well, wait a minute, I'm paying a higher interest rate on the HELOC. Again, it's not so much about the interest rate. It's about the efficiency of the payments you're making, okay? The interest charged on the HELOC is only simple interest. Look at your mortgage and say you're being charged 3%. Okay, what percentage of your payments on your mortgage go towards principal, right? Versus what go to interest? A lot more than 3% of your mortgage payment is going to interest, right? Especially in the early years, it's substantial. Whereas with a HELOC, because it only charges simple, when you dump that $10,000 in, 100% of it goes to principal reduction, 100% of it. So on the mortgage, your first mortgage payment, you're only seeing a $515 reduction in the principal. And the second one, again, $516. Okay, so it's barely moved your principal balance. Okay, whereas with a HELOC, you can see you move down substantially, right? Nearly $5,000 in difference in just 2 months in terms of the principal paydown. And then this just kind of carries it out further. So in year 3, you can see at the end of year 1, you can see it's a $30,000 difference, right? Again, same cash flow. We're not assuming any difference, right? Same cash flow. So a $30,000 difference by year 3, a $96,000 difference by year 5, a $176,000 difference. So by year 5 in your standard 30-year mortgage, you'd still have $266,000 of principal remaining, as opposed to less than $100,000 with the first lien HELOC. So in this example, you'll pay off your house in 7 years rather than 30. And you can see the difference in the interest paid. You save $102,000 in interest payments, even though the interest rate on the HELOC is higher. Because again, interest rate is only one of multiple factors that need to be considered. The overarching factor here is that the HELOC charges simple interest rather than amortized interest. So this again, this is important that the process of velocity banking is automated through the use of a first lien HELOC. Okay, so everything happens automatically. So you are not consciously doing anything differently from what you're doing today. All you're doing is replacing your checking account with this new checking account that will be tied to your first lien HELOC. That's all you're doing. And then you're just depositing your paycheck as usual and paying your bills as usual. But now you have a much more efficient cash flow management strategy. So here it is again. It's a lot more than just a HELOC. It's a first lien HELOC, and it's a first lien HELOC that automates the velocity banking process because it gives you this checking account, right? With the daily forward sweep and the daily backward sweep, which happens automatically, okay? So there's nothing you need to consciously do. We're just optimizing your cash flow. And then, people ask, why haven't I heard about this? Well, in other parts of the world, this is pretty standard, actually. In other parts of the world, this is the standard way of of purchasing and paying down a house. Okay. And then, of course, again, the bank, of course, makes a lot more money off of a conventional mortgage than a first lien HELOC. Now, this we'd have to go into the numbers, but one question would be, well, couldn't I just make extra principal payments to my mortgage and get a better result? Well, no, actually, because you're still having a substantial amount of the minimum payments that you were required to make that go towards interest. Okay. Plus, you don't get all the additional features of the HELOC, where you can put money in and pull it right back out if you need to, right? The automation that goes with it, and so on. But that's something we could look at later, so you can see how, you know, it still works out better for you. Yeah, you can make additional principal payments on your mortgage to pay it off faster. That's true, but it's still a less efficient payment schedule. And again, the interest rate is not as important as you think. Okay. And the way this HELOC works is it's technically an interest only for the first 10 years. Okay. Typically, you're paying it off in less than 10 years. And the interest rate is typically, it's up to you, but typically fixed for the first 5 years. So the interest only payment is actually automatically paid out of the equity in your house, and it's never missed. So again, all this happens automatically. That's the beauty of this. Everything is automated. So it's very, very, very efficient. So again, the most important thing with infinite banking or velocity banking or any of the strategies that I propose is you have to have the financial discipline to actually execute on the strategy, right? So you got to live below your means, right? Make sure that you have some amount of positive cash flow. The more positive cash flow you have, the better this is going to work for you. The more financial discipline you have, the better this is going to work for you. Okay. And then also, more advanced use cases as you pay down your HELOC strategically, you can also pull out from your HELOC strategically to finance investments, maybe to finance the purchase of a specially designed whole life insurance policy for infinite banking, maybe to make a down payment on a rental property, right? This gives you access to capital on very advantageous terms, which is a really nice thing to have. So it's not just about paying off your home more efficiently. It's also about having a much more efficient cash flow management tool that then allows you to have access to capital. And depending on how savvy of an investor you are, you can then use that capital in whatever way makes most sense for you. And this is the calculator, which if you want to see what your numbers look like, I can go through this with you. You can also go to the First Lien HELOC website. I'll include a link to my referral link below. So if you do end up looking into this, I would greatly appreciate you using my link. I do get a small referral bonus at no cost to you. If you want to talk to me about it, feel free to put time on my calendar. We can go through your numbers and see what this might look like for you. So getting a little more into detail again, I think it says 680. I think it's actually 660 credit score or better. Your debt to income ratio. The first lien HELOC does need to be on your primary residence. However, there's something else that's similar, not exactly the same, but similar, called an all-in-one loan that you can get for secondary homes or rental homes. So you can do this on any property, but the first lien HELOC specifically can only be done on your primary home. Okay, so this is just some of the qualifying factors.